Welcome Home Radio Podcast. Are you looking to buy or sell your home? Our team is here with answers to guide you through the buying and selling process. We encourage you to ask questions. Please comment on this show or visit us at welcomehomeradio.net for more information. Bringing real estate, lending, and education together in one place, and to help you make the right home decision for you and your family.
Hey, and welcome to Welcome Home Radio, where real estate lending and learning come together. It is May 13th. I hope everybody had a wonderful Mother's Day weekend with the one that are special. Kids honored your mother. Fathers, husbands honored the women in their lives. Did y'all have a good one, gentlemen?
Absolutely.
Awesome. Tom, did you have a good one?
Super duper peachy keen hunky dory.
I told my wife she's not my mom, so she went down to Houston to be with her grandkids and her son. So thought that was a great way to do it. So hey, we had
more fun, I'm sure.
She did. We got an interesting show because a powerful question was asked by one of our listeners, and I thought, this is a great time to approach this. With the economy the way it is, what does an ARM do for a buyer in this market? So first off, Tom, take us through what is an ARM, because my ARM, I'm not sharing it with anybody. What is really an ARM for a buyer in the home mortgage market?
Well, it depends if you're talking about the left arm or the right arm. One or the other. But an ARM stands for adjustable rate mortgage. And adjustable rate mortgages became attractive back in the 1980s as rates climbed to the 19 and 20% level. And they've remained with us since then. Adjustable rate mortgages are used typically throughout the world to buy properties, and we're one of the few countries out there that still provide fixed financing for long periods of time. Adjustable is...
Can I stop you right there, Tom? Is it not true that we are the only country that offers a 30-year fix?
Well, as I understand, Germany is now using 30-year fixed rates. So there are a couple of countries that feel like they can compete with us in the bond market to sell those bonds safely. And that's the big deal. Is the reason we've been able to do that is we've been considered a real safe country for years and years and years financially, and we're not taking that front seat like we used to do in the world economy. But adjustable rate means that at some point in the mortgage that you agree to pay, at some point your rate will start adjusting, and typically it would then adjust to the market conditions each year after it starts adjusting. So let's say you get an ARM and you lock in your rate for 3 years, maybe 5 years. Typically the instruments are locked in for 1, 3, 5, 7, or 10 years. So you start with that rate and pay on it for those number of years, and then at the end of that period, it will start going to whatever the market conditions are, whether they're up or down or sideways or the same or whatever it might be at that time. ARMs, typically, the reason people are motivated to take them, come in at lower rates than your fixed rate mortgages. That's what
we're talking about, at least a point. I mean,
it would range. Well, it just depends on how they're set up and what vendor is offering them. But I would tell you that typically the range that is good as far as taking them is somewhere between 0.5% and 1%. So if you're getting $1 million loan, a percent difference between your payments is substantial. And these have always been very attractive for higher end buyers. But there's also the case that ARMs can be very attractive or good for first-time home buyers as well. If I can be a first-time home buyer and I get a lower rate for a fixed period of time, statistically speaking, I'm going to be moving out of that house typically before the mortgage rate starts adjusting. And so statistically speaking, these have always been, and I've always tried to provide the option for first-time home buyers to look at that product. And if they can get into a government type of adjustable rate mortgage, those are even more attractive. They're less volatile. They're tied in to protect the consumer before anything else is concerned. So they don't move as much, or they can't move as much typically as the other types of arms that are provided for Fannie Mae or for jumbo type borrowing, big loan type borrowing. So that's kind of it in a nutshell as far as arms are concerned. Arms should always, if you have a good loan representative and you're working with a good loan partner to finance your properties, I pretty much mentioned that any good loan officer is going to bring this up if you're qualified for an ARM. Now, the qualifications for an ARM are typically that you need a little bit better credit, a little bit better histories. So again, when we come into first-time home buyers, if you haven't established yourself, and now that the age for first-time home buying has been raised so dramatically, hopefully you are settled in your spending habits and your borrowing habits and that type of deal. So you do actually provide an opportunity for your loan partner to offer this to you and tell you the pros and cons about this kind of financing, because it can be very attractive. I've used ARMs throughout my lifetime, and just about every one of those, knock on wood, and that's really actually a wood composite. But anyway, if you use that type of product, it can be very beneficial if you're watching the market and if you're aware of what market conditions are, in order to react to the market with the best types of adjustments. And I give this instrument for you. When rates got so high back in the 1980s and I started buying properties, as rates came down in the 90s, people would ask me, when are you going to refinance, Tom? And I'd say, well, never. They say, what are you talking about? And I would simply tell them I have an adjustable rate mortgage, and as the market is coming down, I'm getting the advantage of the market coming down. ARMs don't just, everybody associates ARMs with just going up. So if you have a more traditionally or a higher than traditional market situation, as we have experienced over the last couple of years, and you got your rate when rates were 7% or above 7%, you've seen, if your ARM has already started adjusting, you've seen your rate come down.
Okay.
Do you see now, is that more of someone who is very active in watching the market, keeping an eye on things, stay on top of it? Or is that same solid LO loan officer you're working with, are they going to reach out to you if it's year two and things are adjusting? How does that play out to be mindful of?
That is a great question. When I get my insurance every year, when my insurance bill comes due, again, does my insurance agent call me? That's a yes or no question.
It should be.
There you go.
A good one will.
A good one will. Apparently, none of us have good ones. Actually, I have a fairly good insurance agent. He contacts me typically upon all the renewals that I have, because he knows I'm sensitive to and I'm watching the market, and will typically want to change on a heartbeat if he doesn't say the right things to me, like calm down. So I'm usually on the cliff and ready to jump off, but when insurance comes due. But I will say this: if you get an adjustable rate, you're notified with plenty of time in writing 60 days in advance about what your new rate's going to be. So you're not going to typically do anything until that time frame anyway. So if you're paying attention to your mail, because they have to inform you in writing. They can't do it electronically, or they can do it both ways, but they have to notify you in writing. And if you're paying attention to something coming from your current mortgage company, and it's truly not a mock solicitation of some sort, then you will again have notification far enough in advance. Do I want to refinance? Do I want to pay the loan off? Do I want to pay it down? What would happen, and I tell folks that have adjustable rate mortgages that these higher end folks do, they'll see that the rate went up maybe 1% from what they're paying from the previous year. And what they do is they turn to their reserves that they've been saving up because they didn't pay as much. They didn't have to pay as much in interest. Those reserves they saved up, they go apply it to the principal, and when their new payment comes out, it's based on the lower principal amount that they owe, and thusly they end up paying less on a monthly basis.
Okay, so let's get back to the original question of what it is, and does it help? As you stated, you talked very much 50,000-foot view on first-time home buyers. Why does an adjustable rate mortgage help out first-time home buyers? And it's an advantage or affordability boost to them. What exactly does it take? Because you have it right in that a first-time home buyer is going to stay 3 years, up to maybe 7 at the most, and they'll be moving. What are we talking about here so that people understand the difference between fixed and adjustable rate? You've given it, but I don't think we've clearly defined what's that affordability boost. Is it 3/4 of a point off of a fixed rate? What is that roughly?
Well, it's going to fall in that category in order to be incentivized to get an adjustable rate mortgage. If the current rates are 6%, you're probably looking at a rate around 5.25, as you just mentioned, somewhere between 5 and 5.5 as far as your interest rate. Well, that 0.75% interest on a $300,000 first-time home buyer loan, which I never thought I'd be saying in a presentation anywhere, but on that $300,000 loan, that 0.75% will save you enough over the year that if you save that and start paying down your mortgage, that can be a benefit. Or you save that money up, or you end up using that money to pay off other debt that's at a higher interest rate. So this is a money management tool, and you've got to treat an ARM like a money management tool. A lot of people treat fixed rates as just automatic. I don't want to think about it. My payment's going to go up because I've got, on a fixed rate, your payment goes up because of taxes and insurance. And every year when that goes up, you have to bite the bullet and go, ugh, I got to pay that difference. If you've been able to save up money, you may be able to keep your payment where it is simply because you can pay that differential that your taxes and insurance went up the next year.
Okay, so the advantage here is, one, to get somebody into a home at the more affordable cost, but it does require you to manage the process, whether it's a 3, like you said, a 1, 3, 5, 7, 10. It's going to be fixed for that period of time, and then it's going to start adjusting that next year. So a 3 or a 5 makes the most sense for a first-time home buyer. 7 doesn't, because it's really fixed, but it's at a lower cost, we assume. from what the market was at that time. It keeps you involved, it keeps you aware, and it doesn't mean you're locked in. You have to hold on to this. You can refinance this loan even after 6 months of an ARM if that's what you choose to do. You're not stuck. You're not limited.
That was my next question. Thank you.
And that question comes up a lot with as far as borrowers are concerned, because nowadays people hear their parents back in 2006 and 5 and 4 got the adjustable rate mortgage to buy their house, and they ended up, they couldn't refinance, and then it was a horror story. That type of dangerous product has been pretty much cleared from the market. Those types of loans back then, the adjustable rate mortgages that were created back in that period of time, had features in them that could raise your payment a huge amount. Today, all ARMs are created with what they call caps, limiting how much they can change. So even if you're a first-time home buyer and you're in your 5th year of that mortgage, and you see rates are going to go up next year, but you're getting ready to move because of your promotion, or you've looked for a new job, or you had that second baby and you need to buy a bigger house, all the things that motivate that first-time home buyer to finally sell the house they bought 5 and 6 and 4 years ago, even if you see the interest rate go up because of caps, it will limit how much the payment can go up, and you can plan for that accordingly with your life plans that are taking place at the same time.
So there is a worst case scenario period. It's not, it couldn't double the interest rate. There is a cap of sorts that maximum 2% interest increase max.
Exactly.
So again, a buyer's ceiling, there is a ceiling, but it, like you said, and you gave your own experience of why would I refinance when my rate automatically falls down when the rates are low? But you have to get into that point of understanding, are you fixed for 1 year, 3 years, 5 years, 7 years? And then understand it. You have to stay involved in this mortgage. It is not something you can watch and just let go of. And a lot of people don't want to have to do that. But it is an affordability boost. It is an advantage to get you into the market. Equity-wise, you mentioned about first-time home buyers. Yeah, the age has increased. I mean, we're almost at 40 years old, average first-time home buyer, which is amazing to me. But this is not
next birthday, I will turn that age. Can you believe it?
No.
Jeff's clearly not listening.
I am too.
Well, so this is not.
I'm delayed.
That's what it is, delayed.
This is a loan that is giving you a boost. It allows you an advantage, but there has to be an exit strategy to manage it. You have to be involved in that risk window, understanding what those windows are and when you need to jump out. You may be selling. I mean, especially first time. Again, this is not your forever home. You're probably going to be out of this home in 3 to 7 years, 5 years probably. So it's an opportunity, and a good loan officer will offer you every opportunity out there that makes it affordable. But understand, as Tom expressed, there is higher requirements. It's not breathe in this mirror and there's fog, you get this loan. It is a little bit harder, a little bit more credit, a little bit more assets. All of these things have to come into play for these types of loans to be offered. But they are affordable, and they are a good strategy in this market today, in my opinion. Would y'all agree?
I always agreed that ARMs in the right place and used the right way can be more beneficial than fixed rate loans. Absolutely.
I mean, we can't go around and state it's 0.75% better than a fixed for everyone. That's not true. But the bottom line is, if you go in with the understanding of researching this, can this work for 2 to 3 years, and then I get out or I refinance so forth, as we see the market changing, this is an opportunity for first-time home buyers to have an affordability boost, an advantage to come into the market where maybe they said they couldn't. And yes, Tom, I hate to tell you, but the average first-time home buyer is not $300,000; it's $378,000 purchase. So, understand.
That's in the DFW Metroplex, I take it.
But
That's the
does that
Metroplex.
not also correlate with the fact that everybody is, what's our average age now? 37?
Well, my average age is
My
30.
average age? No.
The average age of first-time home buyers. Ours would never make that. You're correct.
It's almost 40. It's not 37. It is almost 40.
It's almost 40.
That kind of correlates maybe to, someone else is further along in their career, hopefully making a little more money at that point, so they can buy a little more homes for the first one.
And in closing, we've got about 2 minutes here. In closing, yes, the culture's lifestyle has gone to a more lease on credit and debt management programs. I'm going to lease my car, rent my apartment. I'm going to travel more, and I'm not going to save. Well, that doesn't lend itself to the ability to purchase a home the way we look at it. We go all across credit qualifying, income stability, asset affordability, and then, of course, the collateral. That's a mortgage. So that one thing about assets affordability, we haven't learned to save money very well in this country anymore. We used to save 5% a month. We barely cover 1.5% on the average, if that. And so the way credit cards are pushed, the way the lifestyle of you'll own nothing and like it has just permeated out to the point that I think an ARM offers people an opportunity to get some credibility along with equity growth and long-term gains for their life. So I hope we presented an ARM in a positive way because it's intended to be. It is a great tool. As Tom said, it's a tool for finance growth and equity in purchasing a home. Any final comments, gentlemen?
I think it's covered.
Keep your questions coming. We're here to help you get to clear to close as you build wealth, understanding how you can make things happen. Keep those questions coming at welcomehomeradio.net/questions. I'm Blair Thomas.
I'm Tom Holm.
I'm Jeff Duffy.
God bless.
Welcome Home Radio production provided by Lunatic Digital. Check the listing of this podcast for the links to our sponsors. And don't forget to like, share, and follow us on social media. Visit welcomehomeradio.net for more information. This was a Lunatic Digital production. Visit lunaticdigital.com for all your digital needs.